What's up, family? Even though major banks are receiving some major stress right now from people wanting to withdraw all of their money, as well as banks holding bad investments that were made in the past, the Fed chairman, as of yesterday, is still causing more pain. Yes, we heard directly from the Fed chairman on Wednesday, and he said that he is still going to be raising the interest rates by another 25 basis points, or 0.25%. This is very shocking, as the data was actually showing us that there was a 72% chance that he would not raise the interest rates again this month. Well, we know what that means. The financial crisis just gotten worse. Well, guys, in shocking fashion, the Fed chairman announced yesterday that he is raising interest rates again, even though banks are stressing right now, and it is tearing up our banking systems, especially for these particular central banks. Yes, guys, the Fed chairman is raising the interest rates again, 0.25% or 25 basis points, which means that this is going to put another strain on banks, individuals, millions of Americans, as well as those individuals that were in the process of purchasing a new home. It's probably going to change that because their mortgage per month just gotten even higher. But anyways, guys, the federal chairman raised the interest rates for the ninth time in a row this past Wednesday, opting to continue in the campaign against high inflation despite the stress in the banking industry following the collapse of those previously two regional banks. Now, the Fed policymakers voted unanimously to raise their benchmark interest rate by a quarter of a percentage point to just under 5%, which will make it more expensive for people seeking car loans or even carrying a balance on their credit cards. And yes, guys, members of the Fed rate setting committee believe slightly higher rates may be necessary to restore price stability. On average, policymakers anticipate rates climbing by another quarter of a percentage point by the end of this year, according to some of the projections that they have made. Now, whether or not we trust them, that is a different story, considering that this particular economy is pretty much facing a recession or already in a recession, as well as these collapse of these particular banks. This pretty much is all caused by the Fed chairman. So I don't know how much faith you have in them, but that is what we have on the table as of now. And yes, guys, like I said, banks are collapsing right now. Banks collapsing has pretty much set off an alarm across the country, across the world, because it is not just affecting us in the United States. It is also affecting banks in other countries as well, which we saw over the past couple of weeks or so. But there is good news, guys. There is good news. And that is the Fed chairman did let us know that this particular interest rate hike this time is pretty much almost the last one that we are going to see total. Yes, guys, the Fed chairman has indicated that the increases in interest rates is near an end. He said this in the remarks in regards to him raising the interest rate. So I believe that he stated that we will probably see one more interest rate hike before the end of this year. So that is a good outlook if you want to look towards the future. However, we actually have to get through what we are dealing with right now, which is pretty much this financial crisis, as well as this particular recession, jobs getting hit, people losing their jobs, people unable to put food on the table, and much, much more. So anyways, guys, yes, we do have a brighter future ahead, but right now it's going to get tough. It's probably going to get even more tough, especially for those individuals that have their money placed in different banks across the country. And just to take a little bit of a step back, let's go ahead and go back to the financial crisis that was back in 2008. What was the real reason why we pretty much fell into the financial crisis? It says right here that the catalyst for the GFC were falling U.S. house prices and a rising number of borrowers unable to repay their loans. House prices in the United States peaked around the middle of 2006, coinciding with a rapidly rising supply of newly built homes in some particular areas. As house prices began to fall, the share of borrowers that failed to make their loan repayments began to rise. Loan repayments were particularly sensitive to house prices in the United States because the proportion of U.S. households, both owner-occupied and investors, with large debts had risen a lot during the boom and was higher than it was in other countries. So again, the financial crisis that we were dealt with back in 2008 is much different from the one that we are in right now. The one back then was pretty much all surrounding the U.S. housing market, in which they were giving out home loans to people that really couldn't afford those loans. And they were also putting those individuals into particular loans that the individual buyer did not necessarily understand, which means that their particular loans increased over $1,000 after like 2 or 3 years or so, which pretty much made it impossible for those individuals to continue to repay their loans. So anyways, guys, this particular time, the U.S. housing market is pretty strong. However, these rising in interest rates is causing a drain in other areas as well. So again, guys, the financial crisis of 2023 is going to be much different from the one that we saw back in 2008. So anyways, guys, I will keep you guys posted as usual. But anyways, guys, in regarding to the banking collapse that we are pretty much seeing across the country over the past 2 weeks or so, we saw where 2 different banks ended up collapsing because a lot of Americans ended up going to the banks and trying to withdraw all of their money, which we already know that banks pretty much only keep about 10% of your money physical in the actual bank. So it pretty much causes chaos once individuals go to the bank and want to retrieve all of their money. And pretty much once all of this ends up happening to multiple banks and multiple people, it ends up causing what they are calling bank runs, which means that banks are unable to provide the money that you have placed into the banks. They're unable to provide that to you, which pretty much causes the collapse of the particular banks. And so far, guys, global central banks announced a joint action to keep the dollars flowing. Yes, guys, this is a good thing because the world leading central banks jointly announced new action to try to keep U.S. dollars flowing easily through the global banking system, returning to a strategy that was used extensively in past crises that we have seen in the past. So anyways, guys, the Federal Reserve, along with the European Central Bank, Bank of England, Bank of Canada, and Bank of Japan, and Swiss National Bank, with their Sunday evening, aim to make dollar swap lines more readily available. It comes after the Swiss bank UBS took over its rival Credit Suisse with substantial financial guarantees from the Swiss government and its central banks earlier this week. So again, this is definitely some good news. The other central banks are trying to get together to flow money into the failing banks to prevent them from collapsing, because we all know that once we start seeing multiple different banks ended up collapsing, it is pretty much going to cause a contagion around all other banks as well. So we definitely don't want to see multiple and tons of different banks failing the American people. So again, these central banks are flowing more money into these other banks, trying to help them out just to stay afloat as the Fed chairman continue to raise interest rates in our country. And yes, guys, one of a little bit of statistic that I wanted to share with you is that banks have now borrowed more than $153 billion from the Fed, as Silicon Valley Bank in California ended up collapsing 2 weeks ago. And yes, guys, this is the latest information in regards to the banks collapsing. And yes, guys, banks are pretty much pouring money into these other banks, trying to make sure that they don't fail the American people. Yes, banks rush to borrow unprecedented amounts of money from the Federal Reserve, traditional backstop, following that particular first bank that ended up collapsing. Lenders took up $153 billion from the Fed discount window in a week to March 15, topping a previous high of around $111 billion. And banks also borrowed $11.9 billion from the Fed's new emergency loan tool that was launched after we saw Silicon Valley Bank collapse. So again, guys, there is a new program on the table in which it was created by the Fed, in which they are providing a new tool to provide some liquidity for these particular banks to prevent them from failing as well. And then we also talked about Credit Suisse, which was dealing with some major issues because they were dealing with some issues previously before the collapse of Silicon Valley Bank. And now that it's just pretty much put a light directly shining on the negativity surrounding Credit Suisse, in which UBS has stepped up and they have announced to buy Credit Suisse for around $3.2 billion as the regulators look to shore up the global banking system. So again, guys, we are seeing banks collapse. However, we are seeing measures put into place to try and save these particular banks from failing. We do not want to see another bank fail as similar to what we saw with Silicon Valley Bank. That was a huge bank, guys, in which millions of people ended up losing a ton of money. However, the FDC is still trying to figure out how they can issue and save those individuals all of their money that was deposited into Silicon Valley Bank. But so far, we still don't have word yet, but hopefully, guys, they are able to do that very, very soon. And then we also saw where Signature Bank actually failed as well. They ended up collapsing, guys, in which New York Community Bank Corp decided to take over the failed Signature Bank. So again, we saw Silicon Valley Bank fail, collapse, in which the Fed ended up taking over that particular bank. And then we saw these other banks, Credit Suisse and Signature Bank, ended up being on the list of failure. However, other banks stepped in to purchase them to give them more liquidity so that they do not have to fail at all, which means that those individuals like you and I having their money deposited into those particular banks are pretty much being saved as of now. So again, guys, good news is that we are seeing these banks take over these other failed banks and trying to make sure to provide liquidity so that they don't fail as well. Again, we want to prevent a contagion from happening in which all other banks will fail all at the same time, which could be a huge catastrophe across the global markets, guys. So yes, guys, we are seeing these banks at risk right now, but no one really cares necessarily about these banks. The real person at risk right now is the millions of Americans, millions of people in this country. Yes, guys, we saw previously where millions of people were at risk of catching COVID, and then millions of people were at risk of losing their extra EBT benefits, and then we saw millions of people at risk right now of losing Medicaid, and we also are seeing millions of people at risk right now of losing their Social Security in the next 9 years or so, and now millions of people are at risk of losing their hard-earned money that is deposited into these particular banks. We have got to save this. We have got to prevent this huge financial crisis that is ahead of us. And hopefully we are able to do just that, guys. We do not need anything else to happen here in the United States, especially as we are faced with a potential nuclear war with either China, North Korea, or even Russia. But anyways, guys, hopefully we get this thing figured out before the end of the year. And like I said, things are going to get a little bit worse before they get better. But anyways, guys, last but not least, we do have a little bit of good news in that mid-sized banks are actually pleading with the FDIC to create what they are calling an unlimited FDIC bank stop for at least the next 2 years, especially as we continue to see the Fed chairman raise interest rates in this country. Yes, a coalition of mid-sized U.S. banks is calling on the government to insure all deposits for the next 2 years in a wake of the Silicon Valley Bank emergency rescue plan that insured all of the firm's deposits regardless of the size of the amount of money that they have deposited into these particular banks. We all know that FDIC insures people's money up to $250,000, but right now the mid-sized banks are asking the FDIC to insure all of the deposits above $250,000 to be insured for at least the next 2 years. That way, whether or not these particular banks fail in different countries, different states around the world, it will ensure that all of the American people or citizens of this country, their deposits are actually insured by the FDIC, regardless of the amount that they have deposited into those particular mid-sized banks. So again, we haven't heard word on regards to whether or not the government is going to instill this, but it is a very good gesture. Hopefully they do decide to pass this, because it does allow the FDIC to make sure that people like you and I make sure that our money is safe, which is deposited into these particular banks, whether it's mid-sized bank or a large bank or a small bank. So hopefully they will be able to create that very soon, and the American people can get a little bit of a relief knowing that their money is safe in these particular banks. But until then, guys, I hope all this information in this video was helpful to you today. Well, anyways, guys, hey, that's all I have for you today, but feel free to check out some of the items down below, because it is a great way for you to be able to support this channel. Also, if you do have a lot of money in a bank account and it is sitting and not doing anything for you, you might want to think about investing it in Wealthfront, where you can earn around 4.5% on your money that is sitting in a cash account, which is FDIC insured, which means that you cannot lose any of your money, as well as an opportunity down below for you to receive 12 free stocks from Webull after depositing at least like $1. But anyways, those are just a few. If you are interested, check out the links down below in the description. But anyways, if you enjoyed today's content and you want to see more, go ahead, subscribe to the channel. It's totally free. And if you like today's video, then go ahead and hit the like button for us. It really helps out this channel, as well as it tells YouTube to share this video with others. But anyways, hey, I appreciate you guys stopping by and watching, and I hope to see you on the next video. Peace.